Welcome to My Home HQ podcast with Ray Fletcher. Leading the way in buying and selling homes, knowing the current housing market, updating your home without an extensive remodel, or how to stage your home for the perfect sale and more. Portland, Oregon real estate agent Ray Fletcher will bring his 20-plus years experience of real estate, home ownership, and selling homes to you in his bi-monthly podcast. This podcast will be your home headquarters for strategies to achieve success in your real estate investments. Now your host of the podcast, Terry Fletcher.
Hello, everyone, and welcome to the My Home HQ podcast with Ray Fletcher. Our resident home and real estate expert in Portland, Oregon, Realtor Ray Fletcher is here today to chat with me about all things real estate. I'm your host, Terry Fletcher. So our topic today is home equity. And what that is the difference between your home's value and your mortgage balance. And many homeowners have gained a lot of it over the last few years and maybe aren't aware of it because of the distraction of COVID and everything that happened with shutdowns and things over the last couple of years. And thanks to rising home prices, a lot of homeowners are sitting on more equity than they even might think. So according to the recent statistics that came out, a typical homeowner had about $270,000 in home equity at the beginning of 2023. So we're going to talk about, should you tap into it for home repairs, medical bills, college tuition, or any other expenses you might face? And is it really free money or is it adding to your debt? What really is it? And I think Ray is one of the best people to talk about this because I know he's given advice on should you do it, shouldn't you do it, and possibly even tapped into his own home equity in the past. So Ray, welcome back to the podcast.
Thanks for having me.
So when we're talking about home equity, I think some people think, oh, it's free money and now I've got cash and I'm not creating debt. So can you explain first the couple of options when it comes to home equity? I know you've got like cash out, the home equity loans, and then I know they've got the line of credit. Can you kind of give us some insight there?
Yeah, so you could do refinance, cash out. So you refinance the whole balance, and then you take a certain amount out. And you always, the banks always have to keep you at an 80-20. So 20% equity needs to stay in the home at all times so they can give you whatever above and beyond. So if you have 30% equity, they can give you 10% of it. So cash out refinance the whole thing, re-amortize the whole loan. So you start that 30-year or 15-year loan over, and then you get your cash. That's the first one. Home equity line of credit, what they do is they basically put a second loan on your house, and it's basically a savings account. You don't take the money out. You don't pay on that money until you start spending it. So you have a line of credit, once again, keep the 20%, anything above that, you have that in, it just looks like it's like a credit card almost. There's zero balance, but you have an available funds of, let's just say $100,000. Soon as you spend any amount of it, it is amortized like a loan. And so those payments that you're making, let's say you take out $10,000 and the payment amount's only $120, which looks so feasible. So now I could go buy a really cool motorcycle and only pay $100 a month. Well, 90% of that is going to go towards interest because that's how it's amortized. And then some other ones that people do, not so much an equity line of credit or an equity, but you could do a reverse mortgage on your house if you're a certain age. They will basically use your equity in your home to where now you don't have to pay anything for even your mortgage. You just have to keep up with the taxes and the insurance.
And then there's the home equity loan, which is basically a second mortgage, right?
Well, that's the line of credit.
Oh,
that's
it's
the same thing.
Similar thing.
Yep.
Okay.
Yes. Yep. Same thing.
Okay. So my question is that with interest rates the way they are right now, first of all, is the cash out refinance, is that even feasible?
No, because most people right now, if they've gotten a loan within the last 10 years, they should be under 5%. And to get a new loan now, you're going to be over 7.
Well, that's what, I've even seen it hit 8. Because, for example, you and I were talking offline, and your niece, my daughter, she had something already come up with her new build because of bad contractor work in the master bath, or I should say primary bathroom, politically correct.
Yep.
And it's going to cost them just under $18,000 to fix it. And I'm thinking, well, does she just put half of it on a credit card, ask mom and dad for help? Does she, you said you looked for a possibility of a new home warranty. We already found out the homeowner's insurance isn't going to cover it. Or because, she now her loan originally was only 2.9%,
Yeah.
and, she's got about 100,000 equity. Is it worth going to do that? Probably not, right?
Well, it depends. So if she has to put it on a credit card, that credit card is going to be 18%. So a home equity line of credit in today's market is going to be about 10%. So technically, it would be smart. Again, if you're really good at managing money, that's really the key, because there's a cost to get an equity line of credit, and there isn't a cost to get a credit card. So because an equity line of credit, you're going to get appraisals, closing costs, escrow fees, all those things, and it may cost you $5,000 to get $100,000 loan. When on the flip side, you can put it on a card. You just have to make sure that you're very structured in getting that thing paid off. And I haven't messed with credit card debt in a very long time, but back in the day, you could transfer cards and do 0% with no fees. And so that would be a thing we used to do in the early 2000s, and when the market crashed the
Right.
first time.
Right.
So yeah, there's a real cost in getting these equity line of credit. Anytime you deal with money and there's somebody involved, they need to be paid for the work they're going to do.
Well, and the one thing that people need to realize is that this isn't free money. It's being added on somewhere, right? I
You got
mean,
to pay it back,
you got to pay it
100%.
back. Okay. Okay.
And well, and also there is some tax advantages, I suppose, that you could look at if you're in a really high tax bracket, to where an equity line of credit, all that interest is technically a write-off because it is a part of your mortgage. So there is that, I suppose, if you're looking for any light at the end of the tunnel on debt.
Right. Well, and the one thing that I think is kind of interesting about these, homeowners, equity loans and looking at your equity. So let me just play devil's advocate for a second and tell me, I know this had to have happened in the past. And I feel
Mhm.
like at some point, because of how inflated house prices are now, I know that's kind of leveled out a little bit. Let's say you take out that amount and you only have 10% left, and all of a sudden the housing market drops or
Mhm.
crashes. What happens when you lose value in your home and now you have that extra amount on there? Does that change things at all, or?
So it only changes if you're looking to move. So if you
Okay.
pull out, let's say you have 100 grand worth of equity, which means all you can get is 80 because you got to keep 200 in it, and you spend all that 80, and now you basically only have 20%, and then the market flips like it has. Now, I mean, again, if your house was worth, for easy math, 500,000, and now your house is only worth 450, you might have some issues on getting it sold with commissions and maybe some extra debt and things like that it costs to sell a home. So, and that's what we've seen in the past. People were upset, and that's what's called being upside down in your house. You owe more than it's worth because you took out a line of credit, or you took out a line of credit.
Okay.
So, yeah, and spent the money.
So is there, when people ask you for advice on this, is there
Uh-huh.
kind of a threshold where you say, like for example, I said this is going to cost them about 18,000, and
Yeah,
some people want to say, well, oh my gosh, I'm drowning in, like you said, credit card debt. And if you
yeah,
look at any of the reports that are coming out from government statistical information right now, everyone is drowning in credit card debt. They said like
yeah.
18.9% of the country. It's worse than it ever has been. But taking this from your equity, paying things off, and like you said, you want to keep it down because it can just happen to you again. Don't make it a band-aid.
Right.
But it,
Yeah.
it just gets added to your house. But are they looking at it as, instead of 18 to 24% in credit card debt, now they're only paying 8 to 10% as far as interest?
That's exactly right. But then what most people do is once if you're in a lot of credit card debt, or you're just unlucky, it's where you have a lot of medical bills, or you just have a spending problem. I mean, there's so many different ways why people are in large amounts of debt.
DoorDash,
And
Uber Eats.
yeah, eats, yeah, There's so many ways to spend our money these
Millennials.
days.
Yeah.
And
really
when we're bored, what do?
Yeah.
We just look around on Amazon, Craigslist, and just look for stuff that we didn't need. We didn't use it yesterday, but today we want it. And so with that said, if you have a tendency to spend, and now you start spending money that you technically don't have because it's supposed to be tied into your biggest asset, well, now you're just spending everything. And no, it's not advised to ever do that. However, the exceptions to the rules would be, are you staying in your house forever? And if you are, what about it do you not like? Like, is your kitchen making you so crazy that you feel the need to move? And so you're like, I have to redo my kitchen. It's just not functional. We got a blended family, or we now had a kid, or we got something happened where you need something adjusted. So to keep, again, you only live once, and I do believe try to live the best you can, but obviously as cost efficient and all those things. So you just have to look at the bigger picture on why. And for your daughter's sake, for my niece's sake, no, it would not be in her best interest to pull her equity out of her house to fix this issue, due to the fact that, one, it would cost her more to get the loan than it would. So the loan cost would not even out with how long it should technically take her to pay off how she borrowed the money, so to speak. That's how I would look at it.
So really, if people are going to do this, it's when they've kind of they've lost a job, they're out of control, there's maybe some really bad, medical bills, credit card, and maybe they're $50,000 in debt that they're paying, 20% interest on, and they're like, you know what, we've got $80,000 in equity. Let's see what we can do here.
Yeah. Or they've got a kitchen that or a bathroom,
or a roof.
Or a roof, or they want to do an addition because they have a bigger family all of a sudden. Right. So there's definitely reasons to do that. But again, the number one thing you do not want to be is house rich and cash poor.
Right.
That's the issue. And that's what you always have to think about. If I do this, my payments are going up. What does my life look like? And how do I get out of it? And what's and
is really credit scores or is it just having the equity that approves you for that either loan or line of credit or cash out? And I know it's not just a bank you'd go to. There's all kinds of lenders.
Yeah, it's both. And the credit score is going to dictate the interest rate.
Okay.
So if you have a low credit score but a lot of equity, they'll be happy to give you the money. They're going to charge you a ton to get it. And all those factors. Yeah.
I see you coming. Yeah. Gotcha.
Yeah.
All right. Sure. Well, good. Well, this has been really helpful because I think I get this question a lot. I know you get this question every once in a while. So it's nice to be able to at least talk to the listeners about it when I'm talking about real estate. So thank you, Ray. This has been a great episode.
Yeah. Sounds great.
I hope our listeners will appreciate these real estate tips and considerations before jumping into any kind of equity loan or any kind of, borrowing against your house. But now we've given you some options, and knowing when it's appropriate, when it may not be. You have to make your own decisions, but hopefully this gives you some insight. So that's all for us this week on My Home HQ podcast. Join us next time when we bring you more topics on real estate, home buying, selling, investing, and more. Drop us a rating and review on Apple Podcasts, Stitcher, Spotify, Amazon Podcasts, or wherever you listen to your podcast. Make it a great rest of your month, and thank you for listening to My Home HQ podcast with Ray Fletcher.
Thank you for listening to My Home HQ podcast with Ray Fletcher. Drop us a rating and review on Apple Podcasts, Amazon Podcasts, Stitcher, Spotify, or wherever you listen to podcasts. Check out our website and blog at www.rayfletcher.biz or contact Ray directly at realtorrayf@gmail.com to also subscribe to his weekly newsletter.